Pennsylvania. So they have payments for the right to explore for a coal deposit, actual exploration costs, intangible development costs, purchase of excavation equipment, restoration of land for recreational use after extraction. Recall that any reclamation costs have to be added. Let's see. So the company geologist estimates that 1 million tons of coal will be extracted over a 3-year period. After the coal is removed from the site, the excavation equipment will be sold for an anticipated residual value of $60,000. During 2018, 300,000 tons were extracted. Alrighty then. So here we have our depletion per unit here, tons. And what you're going to do here is you're going to consider all the costs of the mine separately from the excavation equipment. And so for the mine itself, your depletion per unit is, well, $2.76 or $2.77 if you want to round up, it's fine with me. But here they use the exact amount, 2.76836 per ton. And during the first year, 300,000 tons are extracted. So you simply multiply the depletion per unit, 2.76836 times 300,000 tons, to come up with your depletion expense. And then their credit is directly to the gold mine. Now, as far as the equipment is concerned, they're going to figure out the depreciation per ton by taking the cost minus the estimated salvage value as their numerator, and dividing into the estimated number of units expected to be produced over the service life of the equipment. So that's 54 cents per ton. And here, because 300,000 tons were extracted in that first year, they're simply going to take the 54 cents and multiply it by the 300,000 tons. So they come up with depreciation for this equipment in the first year of 162,000. All right, so here we have a question. Crystal Corp acquired a coal mine at a cost of $15 million. The mine's expected to produce $30 million over a 5-year useful life. During the first year of operations, 3 million tons of coal were extracted. Depletion for the first year should be, well, let's see, you've got cost of 15 million, doesn't indicate any salvage value, so you take that, divide it into 30 million expected during its life, you come up with 50 cents. And multiply that times the 3 million tons, so you come up with 1,500,000. Intangible assets. Again, you've got your useful life that you have to consider. Now here, intangible assets, um, useful life may be set by uh, laws, such as a patent is only good for 20 years, even if the real life could be longer. Uh, could be set up by regulations, could be set up by contractual provisions. And so those can limit the useful life of an intangible asset. Note here that the asset's useful life might actually be less than uh, the legal or contractual life as well. For instance, in my example earlier about a patent, um, when the U.S. Patent Office gives a party a patent, it's for 20 years, but if new technology comes along that makes that patent useless, certainly at that point, it has no value. The residual value is usually zero, so that's usually not an issue. But it won't be zero if at the end of the asset's useful life, the reporting entity could sell it to someone else for some value. As far as the method is concerned, usually you uh, simply use a straight line method. Here's again under summary of significant accounting policies, um, some information that Intel disclosed. So here, this company began operations in 2018. Early in January, they purchased a franchise from Ajax for $200,000. The franchise agreement is over a period of 10 years. In addition, they purchased a patent for $50,000. The remaining legal life of the patent is 13 years. However, due to expected technological obsolescence, the company estimates that useful life of the patent is only 8 years. Hollins uses straight line amortization for all intangible assets. The company's fiscal year end is December 31. All right, so you got a franchise, and the agreement is 10 years, and a patent that has a useful life of 8 years, and you're doing this straight line. Simple enough, right? Now, understand this. There are some intangible assets that don't have a useful life. In other words, they have an indefinite useful life. If you have such a situation, such as with goodwill and trademarks, you're going to have an indefinite useful life, and thus it's not subject to periodic amortization. What it's subject to is uh, what we call impairment. Every year, management must determine whether or not these assets are somehow impaired in their value. All right, so anyway, understand this about cost allocation, and this should have been discussed earlier. When an acquisition or disposal occurs at times other than the beginning or end of a company's fiscal year, depreciation, depletion, and amortization is recorded for the part of the year that the assets actually used. And so you could use what's called a half year's convention rather than taking the actual period of the year. And so here we have a situation. Actually, it's our original example, right? These were the numbers, but the only difference is instead of purchasing at the beginning of the year, we're purchasing it on April 1. So instead of 12 twelfths of a year, a full year, that first year, they're utilizing it only 9 months. Okay? And so what happens is you have an overlap every year into the next year, at least from a calendar standpoint. And so here you're going to, in the first year, depreciate 9 months worth of depreciation, whatever method you use. And then you still have 3 months worth of depreciation in 2019 that you have to use up. And that's going to go on in every year afterwards. And in that last year, you're going to have, assuming it's, and that's the example here, it's disposed of after 5 years of use. It's service life. So at the end in 2020, let's see, 18, 19, 20, 21, 22. So either in 22 or 23, I think 22, we're going to have 3 years worth of depreciation we're going to have to deal with, or actually 23. Now, that's true for the first two because you've got, again, built into your formula your estimated salvage value. That may not be true necessarily for the double declining balance method because you don't have built into your formula your salvage value. So 2018, 3/4 of a year's worth of depreciation. And then again, we have a quarter of a year. I mean, in straight line, it's pretty easy because you're doing 9 months worth in that first year. Everything in second, third, fourth year, or after that is fine, $42,000 worth. And then in that last year, you've got 1/4 of a year that you're dealing with. Pretty much the same for some of the year's digits. A little more complicated in that you're going to have book values you have to deal with that are different in each year. And then double declining balance method, it gets a little more difficult, but still very manageable. All right, so hopefully this is the last question. A machine is purchased on September 30th, 2018 for $30,000. Useful life estimated at 4 years and no residual values anticipated. The DDB depreciation method is used. The acquiring company's fiscal year end ends on December 31. Depreciation for 2019 will be what? All right, so here we have 4 years, so straight line percentage would be 25%. So you're going to multiply that times 2. So 50% is going to be the percentage you use. In the first year, 2018, you are going to depreciate 30,000 times 50%. So that's going to be have to do this. Well, it's going to be 22,500 plus. Let's see. So in 2018, we're only going to take how much? 30,000. I mean, overall, you're going to you're going to take 12,000 in the first 9 months. And overall, you're taking 15,000. So 15,000 times 50. So 12,000 plus. I have to get a piece of paper here. So first year, 30,000 times 0.50 times 1 quarter, October, November, December, yeah. So in the first year, you take 15,000 times 1 quarter is 7,500. And in the second quarter, or second year, 2019, 30,000 times 0.50 times 3 quarters is okay, so that first year is 3,750. So 30,000 times 0.50 times 1 quarter is 3,750, and then the balance on that 30,000 times 0.5 times 0.75 equals 11,250. Okay. And so at the end of that, what you have is 15,000 book value in that second year for that last quarter times point, and we got no residual value, so you don't have to worry about book value or salvage value or any of that junk. So you got 15,000, 15 times 0.5 times 0.25 equals 1875. So 1,875. All right. So anyway, in 2019, it would be $13,125. Nothing like putting pen to paper. All right. So um, later in the week, I will put out a lecture on parts B and C, but I know that was a long section or a long part, that part A. So anyway, I'll do another lecture later in the week.